Welcome to the Deep Dive. Today we're jumping straight into AbbVie's Q3 2025 earnings call. And it's a bit of a head-scratcher. We've got this classic market puzzle. The company beats on revenue, beats on adjusted earnings, raises guidance for the full year, and the stock immediately tanks about 4.5% on double the usual volume. So our mission today, unpack that divergence. Why the disconnect?
Yeah, that volume jump is key, isn't it? It tells you people weren't just sleeping on the results, they were actively trading, making a clear negative bet right after the call. Even though, like you said, the operational numbers look pretty solid on the surface, we really need to figure out what spooked them, what optics overshadowed that core performance.
Okay, let's start right there with the financials, because it really is a tale of two EPS numbers, isn't it? What were those headline operational results?
Well, revenue looked good. Came in at $15.78 billion. That's a beat. And it's up 9.1% year over year. Pretty robust growth. And the number management really points to the non-GAAP adjusted EPS. That was $1.86, which beat the street's expectations by about 9 cents. So operationally, things look strong.
The core business is humming along then, but then, you hit the GAAP number, the official accounting profit, and that one was jarringly low.
Yeah, jarring is the word. It was just 10 cents, 10 cents per share. And that's a huge drop, like 88.6% down from last year. The reason, a massive non-cash charge, about $1.50 per share, wiped out by acquired IPR&D and milestones.
Right, IPR&D, in-process research and development. Maybe break that down quickly. Why does that hit the book so hard?
Sure. Think of it less like the company losing money operationally and more like a big strategic investment decision hitting the current quarter's accounting. They basically went out and bought potential future blockbuster drugs, things still in development. Accounting rules say, well, you got to expense the cost of buying that potential now, even if the payoff is years away.
So it's a paper loss today for potential gain tomorrow. They're investing in the 2030s pipeline, essentially. But it makes the current quarter's GAAP profit look, terrible.
Exactly. And it's a non-cash charge, remember. No actual operating cash went out the door for that specific line item this quarter beyond the acquisition cost itself. Plus, to make the optics even worse, these kinds of IPR&D expenses often aren't very tax-deductible immediately. So that pushed their adjusted tax rate up temporarily to 24.5%. You see a tiny GAAP EPS and a high tax rate. Yeah, the market can get spooked fast. Questions later.
Okay, that definitely explains the noise. Now let's look under the hood at the engine driving that operational beat. Immunology. This seems to be where the real strength is.
Oh, absolutely. The immunology franchise is performing exceptionally well. Total revenue growth there was about 11.2% operationally. And the two big stars, Skyrizi and Rinvoq, they're really accelerating. Skyrizi jumped, get this, 47% to $4.71 billion. And Rinvoq grew 35%, hitting nearly $2.2 billion. Management calls them the twin pillars replacing Humira, and, the numbers back that up completely.
And Humira itself, still declining as expected with biosimilars entering the market.
Yep, that's playing out just as forecast. Global Humira sales dropped about 55.7% operationally, landed just under $1 billion at $993 million. Management said they expect that erosion to continue, maybe step down a bit more into 2026. So no surprises there, really. It was baked in.
There was a really interesting strategic update for Rinvoq this quarter, wasn't there? Something about its place in treatment.
Yes, that was significant. Rinvoq got a key label update for Crohn's disease and ulcerative colitis, UC. It allows doctors to potentially use it before trying the older anti-TNF therapies in some patients. Historically, anti-TNFs were kind of the standard first biologic try. This gives doctors more flexibility to go straight to a high-efficacy option like Rinvoq earlier on.
Wait, hang on. That sounds like a big deal strategically. Does that mean they can potentially capture patients earlier in their treatment journey? Almost. Lock them into Rinvoq before they even try the competition?
There's certainly the strategic thinking behind it, yes. It could really shift the treatment pathway for inflammatory bowel disease, IBD. It definitely helps cement Rinvoq's position for the long term, a very important move.
Okay, let's pivot to the other big growth engine, neuroscience. They flagged this as their second largest and fastest growing area. How did it do?
Also very strong. Neuroscience grew 20%, reaching over $2.8 billion. That growth came from several products, Ubrelvi and Colipta for migraine, and also Therapeutic Botox uses. What's really interesting is Colipta. It's now apparently the #1 prescribed CGRP drug for preventing migraines.
#1 by prescription share. In a crowded field like migraine prevention, what does that signal?
It signals they're successfully taking share, likely from older drug classes. They're establishing dominance in a really large chronic market. They also talked up momentum in Parkinson's disease, specifically Vyalev, their subcutaneous infusion drug. Apparently, it's 24-hour delivery and better side effect profile, like less dyskinesia, less sedation compared to rivals, is driving really strong uptake.
Okay, so immunology booming, neuroscience booming. It feels like investors must have been looking hard for a weak spot. Was aesthetics the problem? It was down 4.2%. How did management explain that dip?
Yeah, aesthetics definitely softened. Global sales fell operationally to $1.2 billion. Management was pretty direct about it. They said it wasn't about losing to competitors, it was the macro environment. Low consumer confidence, worries about the economy, inflation, basically things that make people cut back on discretionary spending, especially in the US. Botox and fillers are often first on the chopping block. So it confirms that segment is definitely sensitive to the economic cycle.
And the third leg, oncology. That was roughly flat at nearly $1.7 billion. Is flat good enough here?
Well, flat was kind of the expectation. The big story there is the continued expected decline of Imbruvica because of competition in leukemia. But that decline was offset by growth in their newer oncology drugs, like Venclexta. So management seems to see it as stabilized for now. Resilient, holding the line while they wait for newer pipeline assets to come through.
All right, let's talk about the future then. Guidance. Management didn't just maintain, they actually raised their outlook despite the aesthetics softness.
They did. A clear signal of confidence. They bumped up the full-year non-GAAP EPS guidance range to $10.6165. And they also raised the full-year revenue forecast slightly to $60.9 billion.
Basically, they said the extra strength from Skyrizi and Neuroscience more than makes up for the dip in aesthetics. Portfolio diversification working.
And they backed that confidence up with cash, right? The dividend.
Exactly. They announced a 5.5% dividend increase. The quarterly payout will be $1.73 starting in February 2026. That's a strong commitment to returning cash to shareholders, signals belief in long-term cash flow. They also mentioned sticking to about $9 billion in R&D spending for 2025. Continued investment.
Speaking of investment, let's circle back to that huge IPR&D charge, that $1.50 per share accounting hit. We now know what that money, or rather that accounting charge, represented in terms of pipeline deals. Right. It wasn't just random accounting noise. It was tied to specific acquisitions. The main drivers were buying Capstone Therapeutics that gives them an advanced CAR-RT platform for immunology looking way down the road, and also acquiring an asset from Dilgamesh Pharmaceuticals called Gractoisin.
Cortoidicin. Yeah. That's the short-duration psychedelic for depression, right? Major depressive disorder.
That's the one. It's designed for rapid and hopefully durable antidepressant effects after just a short session in a clinic. These are definitely high-risk, potentially high-reward bets on where medicine might be heading in the 2030s.
And beyond those big acquisitions, any updates on the existing pipeline that caught your eye?
Yeah, a few things. They're moving forward with Rinvoq for new skin conditions, alopecia areata and vitiligo, big unmet needs there. But the one that really stood out, I think, was the data on Temab-A. That's one of their next-generation antibody drug conjugates, or ADCs, basically targeted chemo.
And the results looked promising, especially in tough cancers.
Very promising. They showed objective response rates. Let's see, 30% in advanced colorectal cancer when using combination therapy, and 24% response rate as a monotherapy in pancreatic cancer. I mean, those are notoriously difficult tumors to treat. So seeing those kinds of response numbers is pretty significant, highlights the platform's potential.
Okay, last piece before we try to tie it all together. External pressures, PBMs, the IRA drug pricing negotiations. What was the message there? On
pharmacy benefit managers, PBMs, they basically said, look, whatever changes happen, we think our drug's clinical value is strong enough that we can adapt and compete. And crucially, on the Inflation Reduction Act, the IRA price negotiations for Vraylar and Lynparza, management confirmed two key things. First, whatever the outcome, it won't impact their long-term financial guidance. And second, any new negotiated prices won't actually start until 2027. So it removes that immediate uncertainty.
Okay, so let's synthesize. We've got booming operational growth in the core franchises. Immunology and neuroscience are firing. They raised guidance, hiked the dividend. They're making big bets on the future pipeline. Yet the market sells off sharply on the gap noise from those pipeline bets and the cyclical softness in aesthetics. It really feels like, as you said, active re-underwriting based on near-term optics.
It certainly looks that way. And management even called out what they think the market is missing. They explicitly said investors are underappreciating the depth of the rest of the immunology pipeline beyond just Skyrizi and Rinvoq. And they feel neuroscience is seriously undervalued, being the second largest, fastest growing unit, with leadership emerging in Parkinson's and new shots on goal like essential tremor.
So the high volume suggests funds were maybe hitting the sell button almost reflexively on that $1.50 gap hit in the Botox slowdown, choosing to ignore the underlying strength and the long-term story.
That's a plausible interpretation, yeah. They sold the accounting noise, not the fundamental acceleration. Which actually brings us quite nicely to our final segment.
Indeed it does. Time for our This Is Not Financial Advice segment, where we brainstorm an outrageous but plausible trade idea based purely on what we just discussed.
Okay, disclaimer loud and clear. This is not financial advice, purely an intellectual exercise based on the Q3 report. But here's the thesis. The market, arguably, overreacted. It punished the stock heavily for that $1.50 IPR&D charge, which, remember, is a strategic investment decision reflected in accounting, not an operational failure. At the same time, the market seems to be discounting the very real, very rapid growth in the core business, that 47% Skyrizi growth, 35% for Rinvoq, a confidence signal from the dividend hike.
So the trade needs to capture that core value while somehow hedging out the specific thing that seemed to spook investors alongside the IPR&D charge, the aesthetics weakness driven by consumer sentiment.
Exactly. So you could consider what you might call a softness hedge strategy. You take a long position, betting on the core business value based on the non-GAAP beat and raise, expecting a recovery as the market digests the news. But you simultaneously try to neutralize that specific macro risk they highlighted. You could do that with a paired trade, maybe shorting a basket of stocks, or an ETF that's purely exposed to discretionary consumer spending, the very thing management blamed for the aesthetics dip. The idea is to isolate the pharma growth story from the cyclical consumer headwind that contributed to the Q3 sell-off. Capture the core, hedge the noise.
Interesting. A way to play the operational strength while acknowledging the valid macro concern. Okay, quick recap then. AbbVie's Q3 was really a story of massive strategic investment hitting the GAAP P&L, disguising underlying operational strength. Immunology and Neuroscience are clearly accelerating, but investors seemed fixated on the IPR&D accounting and the cyclical dip in aesthetics.
Right. Which leaves you, the listener, with a final thought to chew on. Management is clearly spending aggressively now, through M&A, through R&D, to build their next wave of growth for the 2030s. So you have to decide, is the cost of securing that future growth story showing up today as GAAP noise and a weird quarterly tax rate worth the potential long-term compounding return? That return is signaled by the rising dividend and those accelerating core drug sales. It's a classic pay now for growth later scenario.
A fundamental question indeed. Thank you for joining us for this deep dive. We'll catch you next time.